What does my financial planning services include? A couple things. So first and foremost, we're trying to accomplish two things. We're trying to accomplish to make sure you don't run out of money. First and foremost, that's the big number one issue we have, and we do that. Look, man, I always default to err on caution. And so what I mean by that is let's use a 60-40 portfolio. You're looking at about a 4.7%, 4.8% rate of return. And we're right about a 9 to 9.5% standard deviation. And because of that, we're certainly not swinging for the fences here. We're trying to get singles, maybe a double every occasion, maybe get hit by a pitch on occasion, but we're erring on caution. All right, so we're gonna use that to look at Social Security planning. When's the most opportune time to take Social Security? So a lot of times I'll have a guy, like I just talked to a guy right now. He and his wife both have made decent money. He made significantly more than she did, but he's got a Social Security benefit at his full retirement age, about $2,900 a month. At her full retirement age, she'll get about $2,100 a month. Is it worth it for her? Now, we know that he's going to default. He needs to wait to defer until he's 70. And the reason for that is he's older and he's a man, not likely to survive her. So that could be different for you. But if that's the case, we certainly don't want him taking it early, not 62, heaven forbid, but we don't even want him taking that full retirement age. We want him taking with delayed earnings credits. And the reason for that is because he's going to die early, and then she will be able to step into his benefit at his death. The question that comes secondly is when she should take hers. She should take it early, should she take it at full retirement age, or should she wait until she's 70? Well, there's not much debate, frankly, when it comes to him taking Social Security. There's just not much. He should default. I keep saying default. He should defer. When it comes to her, it's different. We're going to have to crunch these numbers. I mean, should she take it early and be reduced? She'll never get the spousal benefit because the spousal benefit is half of his PIA, and her benefit is going to be more than that. So the spousal benefit for her is off the hook here. We're not going to get it. But she still could take it early, and I think her benefit is $2,100 a month. And if she took it early, she'd get $1,700 a month or something like that. That could go away a ways for helping them before he takes his Social Security, have some income in which to live on while he's deferring hers. We don't know. We got to crunch the numbers. That's exactly what we're going to do. So we're going to crunch the numbers. When is the most opportune time for her to take Social Security? Now, there is occasions when it doesn't make sense for him to default. Why do I keep saying default? It doesn't make sense for him to defer. And a lot of times those will be if they have a significant pension, if there's government pension offset because she maybe she worked as a teacher in Texas or Georgia where she wasn't paying the Social Security. There might be the windfall elimination provision. They might not have enough money. I mean, there's a bunch of reasons why it makes sense for him to take it early. He might not be in great shape. I mean, we don't know. But in this case, without question, he should defer her till 70. Jeez Louise. All right, so that's one thing. So we're going to run these numbers. Does it make sense to reallocate the investments? If the 4.5 to 5% isn't working, should we start swinging for doubles and triples and make it more aggressive? Well, believe it or not, a lot of times that'll actually hurt the plan because you're getting more volatility. And so what might have been more of a more cautious approach because it's less cautious means there's more downside risk. And so sometimes the downside risk might show up that you don't make it as long in your plan if all things turn against you. So that's going to be another thing we look at. So a lot going on there. Certainly taking Social Security certainly what kind of investment strategy should we have? We're certainly going to look at allocations, absolutely. The tax consequences of putting various funds, various investments, and various Roth accounts, taxable accounts, IRA accounts, rolling money over. A lady and guy I talked to yesterday had them bust out their estate docs. I wanted them to read explicitly what their power of attorney said. Took a little bit of time, but they were able to identify that it is a durable power of attorney and it's effective immediately. That's what we want to identify for sure. I'm not an attorney, so I don't pretend to be one. But the issue with a durable power of attorney is if it's durable means it survives incapacity. So that means it's good to go now, maybe, if that's what the document says, but because it's durable, it does indeed survive incapacity. The question that comes to mind is, when is it effective? My wife and I, it's effective today. Charlotte has unencumbered access to my money, and I have unencumbered access to her money too. without having a doc sign off on it saying that she's incapacitated or anything like that. I mean, look, I'll leave that up to you and your attorney, but generally don't want that because that just puts more things that, more hurdles that your spouse has to jump, or anyone has to jump over in a time of need. We generally don't want that. So we're going to look at the documents. Who are the executrix of your will? Do you have a trust? Yeah. Is it funded? Is it a living trust that's not funded, which happens all the time? Do we have the titling of your assets correct? Who owns what? Are you both, you and your spouse, on the deed? Are you planning on gifting a portion of your house to your kids so that way there is no probate? And I'm not a big fan of that. All this stuff comes into financial planning, and we're going to talk about all this in terms of deciding if you're going to run out of money, and then on top of that, the strength of your financial plan. Is your beneficiaries correct? I hate to say it, but what if you what if you have an ex-wife as your primary beneficiary because you got remarried and you forgot to name your current wife? And I mean, we have this stuff happens all the time. This is the stuff that's real financial planning. It's incredibly important. Do you have losses in your accounts that we could sell to get some tax capital losses on there to offset some capital gains? I had a guy the other day who's talking about giving away a loss asset to his charity. No, don't do that. We can't. That's the kind of stuff we can't do. We want to give growth assets that have gains in there. We don't want to give loss assets. That doesn't make sense. Now, how would he know this? He doesn't. He doesn't do this for a living. I do. So this is the kind of stuff we do in the financial planning. All this stuff, it flows into one context of, are you going to run out of money? Once we establish either yes or no, and if the answer is you could, then we got to figure out what do we do. Do we have our expenditures down correctly? Are we overestimating and whatever we're using? So just real quick, for overestimate or estimates, like I said, I err on caution. So my stocks, I anticipate 7.5% rates of return going forward. Bonds, 3.5% going forward. I'll probably reduce that now with the interest rates as low as they are. But right now I'm comfortable with 3.5% because that includes government and corporate bonds, and 1% for cash. And I use that based on John Bogle, rest his soul, Jeremy Siegel over at Wharton, and then Robert Shiller over at Yale. Yeah, the big three, essentially. We got big three, the three titans of investment prognostication, and I read those guys religiously. And essentially, I think if you do look at Vanguard and these other three, Bogle and whatnot, Shiller and Siegel, you get a pretty good gauge of return: 7.5% stocks, 3 to 3.5% bonds, and 1% cash going forward. I inflate Social Security by 2.6% a year. The reason I do that is because that's what the trustees report says. So, I mean, why would you do anything else other than what the trustees report says? I use medical expenses. I inflate that at 5% a year, roughly twice the rate of Social Security. Why? Because that's what the CMS, Centers for Medicare and Medicaid Services, says. 5%. I think it's 5% a year. It is 5% a year, but still, that's what we're using. So roughly twice the rate of Social Security. A general inflation, I inflate at 3%. All right, so what happens here? You're getting 2.6 increase on Social Security, but it's costing you 3% increase in cost of living, and it's costing you 5% increase on your medical expenses. And on top of that, I'm erring on caution on the lower end returns. We're not doing Dave Ramsey 12% stuff here. No way, no siree. All right, so that's the first part of the financial planning. The next part is we're going to do heavy on taxation, and this is what I love. I love doing the taxes. We just plan Roth conversions. In this case, the guy I just talked to defer his Social Security and then pull money from his 401ks. Absolutely his way to go. So essentially has no taxable income other than what he's pulling out of his 401k and IRA, and that way he can defer to take Social Security later. It's just all tax planning. So we have a line item of taxes. You don't see it here, but I got spreadsheets I run. I say, okay, if we're going to start converting, and the guy that I was working with this couple yesterday, what if we did 50,000 a year? What if we did 100,000 a year? What if we did 150,000 a year? And so in economics we call it diminishing returns. And so in these guys' case, 50,000 a year, so it's essentially 100,000. 50,000 a year for Jane and 50,000 a year for Joe for conversions look pretty favorable for sure. In terms of leaving the most to their heirs in the least taxes. All right, so essentially if we're going to convert $100,000 a year for these guys, they're going to reduce their overall taxes by about $400,000 and yet leave more, roughly about $250,000 to their kids. And on top of that, they're going to leave $250,000 more to their kids tax-free because they no longer have traditional accounts which are tax-deferred but taxable to the heir. Now they're just leaving them taxable accounts which have a step up in basis, so they're tax-free to the kids and Roth IRAs. So essentially, we say, okay, if we don't do any conversion, this is what happens. If we do 100,000 conversion, this is what we're looking at. Again, this is just all, we don't know. We don't know. It's all speculative. We don't know what the future tax rates are going to be. We don't know future returns, but what else can you do? And then we looked at 150,000 because we're thinking, well, if 100,000 is good, 150,000 should be better, right? $75,000 per. No, it wasn't. 150,000, actually, again, diminishing returns. It's too much. And so in this case, we left less to the kids, and we paid, even though we did pay a little bit less tax, we ultimately left quite a bit less to the kids. So it just wasn't worth it because they're paying too much on the front end. And we'll do that a lot. In fact, a lot of folks with pensions and whatnot will say, hey, what happens if we start doing Roth conversions? And it just doesn't quite usually work out as what we hope. But we don't know until we start crunching the numbers. And so that's what the financial planning consists of. I offer no guarantee of your happiness, your satisfaction with it. I don't know. You're paying for my time is what you're paying for. You're not paying for the end result because I can't give you an end result. So, I mean, why would you expect an end result anyway? Because you don't know. I mean, literally, we don't know. The financial planning that we do today will be invalid a year from now. I can't stress that enough because things change. Investments change. Tax laws change. People get hurt. People get sick. People inherit money. All this stuff changes. It's just the way it is. And so that does not mean you need to redo the plan every year. No, what I tell people who are interested, I say, look, just, hire me $500 a pop after we do the initial planning for an annual checkup. Now, I don't know what the fee will be next year. I could easily change. I don't know. But as we sit here today, I tell folks, look, you get $2,500 on the front end for the plan because all the heavy lifting done is doing the planning. After that, it's just an annual check-in if you want. As I say, I'll probably charge you $500 a pop just to check in. And then usually I'd like to look at 1040. I think looking at the 1040 is pretty important, especially Schedule Ds. But also there's other schedules in there too. Hard to imagine you're itemizing once you're going to retirement. But still, the Schedule Ds are pretty important for sure. Just your taxable income relative to your pension, Social Security, RMDs, required minimum distributions, and all that. We definitely like to look at that once a year because it might say, there's an opportune time to really start doing some Roth conversions here for sure. I don't know, but that's generally speaking what I'd want to do is look at your statements, your investment statements, and your 1040 after we do the plan. Every year thereafter, are there opportunities in the investment statements to sell something for a loss, to offset something for a gain? Should we get out of some mutual fund that's going to have a significant distribution, taxable distribution to that's going to affect your Social Security income tax, going to affect your income tax as a whole? We don't want to have that. So looking at the taxes, looking at your investment statements is pretty much all we need to do on a regular basis going forward for sure, if you want. And you can do it once every year, once every 5 years. It doesn't matter. It's completely up to you. And that's pretty much it. So again, if you're liquid net worth consists of all your investable assets and cash. You have $1 million at the bank, that's liquid net worth. You got $1 million in your 401k, that's liquid net worth. If you got $250,000 at the bank and $500,000 in your 401k, that's $750,000 of liquid net worth. So if your liquid net worth is above $500,000, the fee is $2,500. And no refunds. And I need the money up front. There's all there's to it. I don't do half and a half. I just don't have the time for all that stuff. And so I get it. You're paying me $2,500 sight unseen. I mean, you know me from YouTube, but you can easily find where I live. But you don't know if I can take your money and run away with it. I get that. That's a risk, and you don't know if you're going to be successful or satisfied with the result. I get all that. It's a risk that you're going to have to take because I'm not taking that risk and assuming that you're going to pay me. Trust me. Was it once bitten, twice shy? Was that the glam rock song? Whoever did that. After being bitten twice or more, I don't do that. I don't get bitten anymore. Just can't have that. Absolutely not. So if your liquid net worth is under $500,000, I charge $950. And again, I don't offer refunds. I do need the money up front. But once I get the money up front, I get you set up the software. And for that, I need you to get in there and start filling out the best you can. Don't kill yourself with it now. Literally, the software is, you don't do it for a living. I do. So just do the best you can. I need it filled out though, but don't make it, it's not a marathon here. Just do the best you can. We set up an initial call to go over, make sure all the I's are dotted and the T's are crossed to make sure everything's in the right place. After that, we go over stuff. I get to know you a little bit more in terms of what you're trying to accomplish here. After that, then we hang up and I crunch the numbers. I start doing my spreadsheets. I start looking at planning options. And then we set up a time, usually the next day or two, to review what we come up with. And that's going to be the plan, so to speak. And there is no big PDF file or anything. I certainly don't send you a leather-bound thing that just sits on your nightstand collecting dust. That's just dumb. Don't do anything like that. So that's kind of how it works. And then, of course, you have access to the software as long as I continue to pay Right Capital. I love Right Capital. I think it's great. They change stuff all the time. I'm just a huge proponent of the software. As we sit here today, it's not available to the general public, which I think stinks. It'd be cool if it were, but be it as it may. I'm trying to think whatever the questions I'd want. We're going to talk about your life insurance like the guy I talked to today. He's not going to need life insurance here in a few years, so we're going to cancel that out of the portfolio, out of his expenses. We're just going to cover everything, man. I mean, that's no hold bar. I mean, no holds bar. I mean, if you're in your second or third marriage, we're going to find out, are you good to go with, we got the Brady bunch. Was it Tom and Jane Brady, Janet Brady? There was a lady, I forgot what her name was. Tom and whatever the blonde head lady was, Liz Brady. Anyway, they had 3 kids each. Well, if Tom dies, who's going to be the heirs? Is it going to be all 6 or just his 3 or what? We got to talk about that. Well, and here's a case not too long ago where the trustee of the trust and the executor was a guy. Was it stepson? If I marry somebody else and they already have kids, is that my stepson or my son-in-law? I can't remember. But anyway, it was a kid. It was the son of his second wife. And I said, are they going to be okay with that? Your own children, because he has his own kids from previous marriages. Are they going to be okay with that guy being the executor? Again, executor is the man who settles in a will. Executrix is a woman who settles a will, or in the trustee in this case. Are your kids, Joe, going to be okay that Jane's kids are the trustee and the executor? He goes, I don't know. So that's something else we need to dive into. And that's where you need to look at your actual estate docs to make sure it's good to go. I guess that's it. So if you have questions, put them in the show notes, but that's what I offer for my plans. And I'll put this up on my website. Again, if you want to engage me, I love it. I don't know what else to say on it. I think I've said enough here, so I'll let you get out of here. All right. Thanks, guys.